evening, everybody. So I'm the tiddler here today. So we're a cash shell. This is our agenda, which I'll go through with you. So Pristine Capital was formerly called More Acquisitions, listed as a cash shell, which you can't do now, of course, on the main market. This was done in 2022. They attempted to do a reverse takeover. It didn't quite work out, and we came in January 24. And instead of buying in the market, we subscribed for new shares. We wanted sort of what's called skin in the game. So, and we've topped up since that time. We're talking to a number of potential purchases at the moment. We've increased our holding, as you can see, to 22.5%. That's our share price at the moment. And with a market cap of just $1 million, but of course we're just a cash shell. Just showing you the expertise, that's me on the left. I've listed 3 companies. This is my 4th. Stanley is a serial entrepreneur. He's my partner. He's been my partner in previous 2 companies. He had a very successful commercial business doing searches, that's company searches, things like that, which he sold. But his main thing was he bought and built up a share registrar business called IRG. He then bought Barclays registrars, and then he sold the lot to Capita for £100 million. Andrew Perloff is also my partner. He's not on the board. He's an investor. He's got his own AIM-listed company called Panther, which he bought into in 1972. And you can see he's increased NAV astronomically since that time. So I started a company with my 2 partners called Pristine Capital in 2010, and we had certain ideas about how to make money. And we decided the right way to do it in the real estate business was to buy companies rather than buy properties. The issue is, if you buy commercial property, you pay 5% stamp duty. If you buy the company that owns the property, you pay 0.5% on the share value. So we bought quite a little company back in 2011. It was under £2 million. Stamp duty was nothing. But then we have saved probably about 12 million in stamp duty while I ran Pristine Capital. Now, as an example, in 2013, we bought a company off Quintain. And I'll come to it in a minute about distressed property, because Quintain were not in distress, but they had a distressed subsidiary. Their subsidiary we bought for a value of just over 39 million, and the reason it was distressed was they owed the bank 38 million. So all they had there was £1 million of equity. So all they wanted to do was to get out. And that's the sort of acquisitions that we're looking for. Companies that need to sell because there's no point in holding it. So when we bought the Quintain portfolio, which we paid 39.25 for, because they owed 38 million, we only paid $1 million for the company. So instead of paying 2 million stamp duty on the properties, we paid £5,000, which was on the share value. The other good thing, which is why we focus on companies, is that the Quintain subsidiary had £22 million of inherent tax losses. So we took over those tax losses, and in fact, the following year we bought another company which had 10 million of tax losses, and in consequence, what then happened is our tax charge right up to 2019 was either nothing or very, very limited. And we created the value in buying these portfolios through proactive asset management. That's how we make our money. We buy a property for £1 that is probably worth 120, and we turn it into 150. That's really what we do. And we add value through development and refurbishment, which I'll come to in a minute. And we had a progressive dividend growth right the way through. When we started, 3 of us bought into a little company called Leo Insurance. Some of you might remember it. In 2010, Leo Insurance was the smallest company on the London Stock Exchange. It had a market value of 108,000. That's how small it was, and we bought 29.9%, and we used that company and we built a portfolio up to 280 million. So I'm going to give you a case study as to how we make our money. So in the Quintain portfolio, which we bought, there was 100,000 for office building called Hudson House, right next to the station, an old British Rail development. And when we bought it, it was 80% empty. And because of that, it was only valued at 3.8 million when we bought it. So 80,000 feet was vacant. Quintain had lost interest. And the problem with having vacant commercial property is you pay empty rates at 100%, and you also pay the service charge on the vacant space. So in consequence, it was costing Quintain 600,000 a year just to keep the building, which was, looking back, quite ridiculous, but that's what they did. We decided to let as much space as we could for whatever we could get for it, and within 12 months, we were effectively cash flow positive. We worked on the planning, and this is what I call about active management. So you can see 3.8 million value in 2013 when we bought it. Eventually, we secured planning consent for 127 apartments and 35,000 feet of offices. And when we secured that planning consent, it was revalued by Cushman & Wakefield at 17 million. So we had a paper profit of 14 million pounds. But we were an entrepreneurial property company, and we were always cautious. And we looked as to whether we should develop it, sell it, or joint venture it. We could have sold it and made a very good profit and walked away. But we looked at all the figures, and there was much more money in it. We secured a facility from Barclays Bank, with whom we've got a very strong relationship. And in consequence, notwithstanding that COVID came halfway through, we only finished 3 months late, but we finished on budget, and literally within 12 months of completion, and completion actually came when lockdown was finished. We had sold 80 apartments, 75% of the offices were let, and the bank was repaid. So it was outstanding. That's how it looked before we did the development, and that's how it looks now. This is Hudson Quarter, a minute from York Station. We were considered pioneers at that time, and some of you might have read that one of the biggest regeneration projects going on at the moment is at York Station, called York Central, where they're intending to build 1 million square feet of offices and 2,500 homes. And we are just a minute away from there. So we think there's a particular opportunity now that was around in 2013, and we think it's being repeated. So what are we looking at? We're looking at acquisitions, one, distress, or two, properties where the vendors will accept our shares in part payment. And in our last company, Palace Capital, when we bought the Quintain portfolio, 50% of the consideration was in shares. And the next one we bought, which was effectively a receivership sale, the vendors took all shares. So that is a great opportunity to use it. We think at this particular time, it's a golden opportunity to increase income and growth with the asset management. You might have seen a week or two ago in the Times that Blackstone have called the bottom of the market in terms of property, and they're in the market to buy, as are we. So we're looking for over-leveraged portfolios, and you'll be quite staggered because I see them. There are private property companies who don't think they're over-leveraged, but they are. Their loan to value is like 65 or 70%. In the listed sector, you never want to go above 40. You probably want to remain at 30. But we think there's an increasing opportunity now to take advantage of acquiring these portfolios, using our shares where necessary. So I'm just going to give you some quick examples of what we've picked up. So we weren't really around to do these sort of things, but there's a building called the London Assembly in Fulham Palace Road. When you go south down the Fulham Palace Road from Hammersmith Broadway, on the left, you won't think so, but there's a 250,000 square feet complex there. And that was bought by AXA in 2014 for just under 82 million. They spent another 20 million on it and then sold it for 52 million to a Middle Eastern investor. They just realized it had gone hopelessly wrong and they just wanted out. The second one I want to highlight is in York. It was 142,000 square feet, bought by the NatWest Pension Fund for £43 million. They put it on the market for 34 million about 18 months ago, but could only get 25 million. And that was yielding 13.7%. So these deals are available. And the final one, which we know about, is a multi-let office building near Reading Station called Abbey Gardens. That was bought by Palm Capital for just over 40 million in July 2017. The bank decided they wanted out. It went on the market last April at 25 million, and it's been sold for 10 million. So that is a classic example where the bank just wants out. And they sell, whether they get 10 million or 11 million, to them it doesn't matter. They just want out. So we think this is the opportunity. So the interest rate cycle, we think short-term rates will drop a bit, not a lot. We think the economy will grow a bit, not a lot, but it will. We have got political certainty. It might not be what we want, but we've got it. Commercial property values are beginning to stabilise, and there are some looming refinancings coming up within the commercial property market, where we think there's going to be quite a few opportunities. You've got to select the right sectors. Some people shy away from certain sectors. We go for unloved sectors and try and turn them into loved ones. That's what we try to do. We are very counter-cyclical. But the banks 6 months ago on the commercial side were not really foreclosing, but they are now at an increasing rate. And we think that's where the opportunities are. So we think we will focus on the right assets, and we can deliver the income and capital growth like we did before. Our active management style is to take hold of an asset, as I say, buy it for £1 when it should be worth 120 and make it worth 150. But focus on compounding dividend returns. That's what we did last time, and that's what I intend to do again. So talking about small mid-caps, and nobody really realised this. If you look at some of the larger property companies and look at their market cap, you'll be quite staggered what it is. So the second largest property company in the country is Land Securities. And Land Securities market cap 25 years ago was 5 billion. It is only just over 4 billion today. That's not in real terms, that's in actual terms. It just hasn't grown at all. And another one is British Land, which is another one. And they're two monoliths that have found it very difficult to provide the returns to investors. Now, St Modwin was a really great company started by Stan Clark. He sold it in 2022 for 15 times what it was 25 years ago. You then look at Workspace. So Workspace in 1997 was 40 million. That was the market cap. Today, it's nearly £1 billion. And then you've got Primary Health, which was 40 million in 2004. It's now 1.2 billion. And we always say that big companies were small ones. So we're looking at a few interesting transactions at the moment. One is a mixed-use commercial portfolio. Private family own it. They think there's an opportunity now in the listed market, and we're talking to them, if we can agree a price, and we're nowhere near it at the moment, about them taking a stake as part of the deal. The second transaction is a private property company, and this is why I talk about highly leveraged. That's in their books at £100 million, but they owe the bank 60, and 60 is quite high. The equity value is 40 million, but to us, the attraction, if we can do something like that, again, is we only pay stamp duty on the share value, not on the property value, saving a considerable amount of money. And the last one we're looking at was worth £20 million. It's probably a bit too small for us, but that's again is a private family property company. In my time at Palace Capital, we focused on the regions. That's what we did. I was travelling to the regions every week. That's why we've got a really good network of people in the regions, and that's where we're actually finding deals. We think there's huge opportunity up there, particularly on the corporate side. You come across private property companies in the north, in these very rich areas of Cheshire and Harrogate and places like that, companies you've never heard of, but they're quite big. And some of them are big family businesses, and one or two have decided maybe now is the time that we all sell out. So we have the management expertise to do it because we've done it before. We think we must focus on distressed real estate, which I again stress is not necessarily a distressed seller, but it's distressed property. We think now there's a gap for a small to mid-cap property investment play. The bigger companies are just not providing the returns that they should. We can issue shares to vendors in order to move to scale. We are fully aligned with our external shareholders, and we think this is a timely opportunity to outperform. So my partner, Stanley Davis, stood down as chairman in December 2021. I stood down in June 22, having founded the company. I did not agree with the board decision to liquidate the portfolio and return the money to shareholders. It just doesn't work. The problem with it, if everybody knows all your properties on the market, you're just not going to get the value. And talk to any real estate analyst, he will tell you will lose at least 20%. So I was against it, and I left Palace Capital nearly 3 years ago, and what I said has in fact come true. The share price languishes. But on the day of my departure, we announced absolutely record results. Simon Thompson very kindly commented I left the company in good shape. These were our results on the day I left. Our income was up, our IFRS profit was up £30 million, adjusted profit up, everything was up. We had a record-breaking year. In the 12 months of that financial year, we sold 14 buildings. And just to tell you, I sell buildings. Some people hold on to them, but I sell buildings. And we sold 14 buildings which were either too small, needed too much money to get an energy performance certificate, or were empty, or partially empty, and costing a fortune in empty rates. So we sold 14 buildings in the last year I was there, and at 19% above book value. And when I left, we only had a 28% loan to value, 30 million in the bank. I left it in good shape. So we think we can do it again. I've got the same partners, and I'm presenting to you today in case you might want to join our journey. So thank you very much.
Gentleman here, please, Martin. Thank you.
Am I going to get the same question?
No, it's a different one. So, in the case of the second acquisition that you have showcased, the one with the 60% loan to value, how do you plan to increase shareholder value apart from repaying 20% of the loan back to the bank? And if that's the way, are you planning on reducing are you planning to pay back the loan? I mean, how are you going to get the money to reduce the loan to value from 60 to 40?
We know the two banks that have got the loans. We also know the two banks are not over happy. We know that, right? And thirdly, they say it's 100 million. That's them. We might not pay 100 million. We might pay much less than that. And we think it's one of those possible acquisitions where the banks will have more of a say. They're always uncomfortable at that sort of level. And is it worth 100 million? That's their value, it's not my value. So in consequence, the deal, if we do a deal with them, in the end might be quite different. You know, that's our scenario.
Thanks for the presentation, Neil. Just a question on that, the regeneration of the buildings or properties. You mentioned quite a lot about like inner city. Is there any thought about like data centres seem to be the big words at the moment, or like warehouses and things like that? Yes.
So we think planning is important. You've all seen what the government are trying to do with the planning system. I've got to tell you, with the planning system, half the problem with it is the people who are trying to get planning permission go about it the wrong way. When we wwent to get our planning consent in York, right, the minute we bought the building, I sent a note to the chief executive of York Council and said, can I have a cup of tea with you? And I did. And I sat with her and I told her what we planned for the property. And she sat with me for an hour. And from that time on, we had a wonderful relationship with York City Council. I was going up every other week during the planning process, meeting councillors, talking to councillors, talking locally. And the other thing that we did with York, which I learnt from Gerald Ronson actually, he always said to me, when in Rome, do what the Romans do. And with our scheme in York, every consultant on that scheme, bar one, came from Yorkshire. We didn't appoint anybody from London. Only our project manager came from Birmingham. Everybody else was from Yorkshire. So our planning consultant, our architect, knew the council very, very well, right at the beginning. So what we decided to do, we had an exhibition, which we didn't have to do, but I did it. I met the local civic trust. I met the local 20th Century Society. You have to engage. If you don't engage, you'll get opposition. And when I went to the planning meeting, you sit literally in front of about 35 people. It's on a webinar, everybody watches it. And they grill you. And we thought we were doing well until the leader of the Labour Party got up and she had a go at me. And she said, I'm absolutely disgusted with your scheme. She said, you have absolutely no affordable housing. There's no social housing. Why not? And I said, the reason why not is that we believe York needs businesses. So instead of social housing, we're putting an office building there. And we're going to build that office building without a tenant. And it's the first speculative building of 35,000 square feet that will be built in York for 30 years. That's what we're going to do because we think York needs businesses. And to her credit, she apologised to me. And she said, you're 100% right, I'm with you. And we got it unanimously. So planning is all about engagement. So my belief is you can get the consents, just got to go about it the right way.
Thank you very much. Any other questions from the floor? Just leads me on from what you just said then. Obviously, you've got for building offices, those people have got to live somewhere.
Sorry?
You're building offices, office space. They're going to live somewhere in York.
Yep.
So what the argument you was just given then about, you know, building office space and offices.
Well, after the great thing is,
Yeah.
right? And I'll just tell you for 2 minutes, which is quite important.
Yeah.
When I went to the Civic Trust, right, it's quite scary, right? You go into Civic Trust, there's 20 people sitting around a table, nobody smiling, and you go in there and you've got to give your presentation. And we gave our presentation, and the chair said, right, in case you didn't know, she said, we are a group of retired academics, planners, and architects, but we think we're commercial. So, question went up, first question, excuse me. He said, what? He said, nobody has built 35,000 feet of offices in York without a tenant for 30 years. Why should I believe you're going to do it? I said, did you ever see that Kevin Costner film? She said, not Field of Dreams. What? Build it and they will come. I said, yes. I can't prove it. The biggest rent, the best rent they ever got in York was £20 a foot. We had to get 25 to make it work. And we said, we believe we will get £25 a foot. In the end, we got 26.50. And then we got a second question. Some guy got up, he said, how do I know when you get planning permission you're not going to sell the site, make your money, and go back to London? How do I know that? I said, you don't know that. But if there's no material downturn, we'll build it. They said, that's fine. And we did build it. So it's all about your word, honesty, integrity, and all that stuff. And we did build it. So, you know, the rest is history.
Brilliant. Great presentation.
Okay.
You got a question, Edward, quickly? Just a quick one from Edward there, I think.
I see you've got shares that presumably could be marketed, but would there not be a significant rights issue at the time that you start doing things?
Well, there'll be a fundraise,
Right.
but it
Okay.
depends. You know, there will be a fundraise, right?
Okay. And what is the liquidity of the stock at this point in time for anyone who wishes
Well,
to buy it?
This is the absolute honest truth. There was a shareholder who had 6% of our company, who I got to know soon after we bought the shell. Got to know him very well. And then he rang me up one day and he said, look, I'm very sorry, but I've just taken a bath on another stock and I'm going to have to sell my stake. So there could well be a bit of an overhang for a bit of a while. I'm sorry. And you know, he rang me 30 minutes later. He said, it's all gone. When? So that was it. And I think about a month ago, maybe right, there must have been 10 million shares traded in early part of January. So people want to buy, they can buy, and people want to sell, they sell. We've never had we never had a liquidity issue at Palace either. You know, there's all this talk of smaller companies having liquidity issues. We never had a liquidity issue. You know,
Okay.
depends who it is.
Great.
It's a slightly personal question, but given that you presumably made good money, as you've described it, from Palace, why are you not more heavily invested in this company yourself?
Who said I won't be?
I'm sorry?
Who said I won't be?
Well, in a sense, in business terms, £1 million is not a great deal.
No, but we could never get. We remember when we bought the shell, right? There were certain restrictions on us. We were not allowed to buy more than 19.9% between us. If you buy more than 19.9% in a main market shell, you've got to issue a prospectus. So we couldn't do that. So we had to buy less and then buy afterwards. That was the reason.
Okay, I didn't know that, and thank you for educating me on that. Thank you
That's
very
all right.
much indeed.
Thank you,
Right.
Neil.
Okay.